Hi, everyone. My name is Andrea Hoch. I am the Director of Investor Relations at Air Asset Management. I am here with Air's CIO, Chief Investment Officer, Steve Luongo.
Good afternoon, everyone.
Okay, so we are here to talk to you all today about accessing greater risk-adjusted returns and portfolio diversification through an uncorrelated strategy. So what does that mean exactly? Air Asset Management is a Chicago-based hedge fund management firm with $600 million in assets under management. We focus on longevity-based assets, primarily life settlements, as well as annuities and structured settlements and private credit opportunities. So I'm going to click ahead here to a slide that we think we should start off with. Life settlement basics. So Steve, I know a lot of people in here can read, but why don't you tell everybody what a life settlement is?
I shall. So as I look out amongst the room, I have a question, which is, how many of you here are familiar with life insurance policies as an investment, or basically what we call life settlements? Okay, good. So life settlements have been growing in popularity, and I'm sure many of you have been or have seen commercials on TV where there's this older senior couple and they talk about how they can sell one of their life insurance policies and they could essentially generate cash value for it. Well, the basics of that life settlements work, they're really very straightforward and very simple. People generally have two reasons to sell an insurance policy. One is that many people are overinsured, and usually happens with affluent people who may have grown a business over many years and continually bought additional life insurance policies. And then there's a certain point in time where they realize that their kids are set, they don't necessarily need excessive life insurance. And as a function of that, one way to really reduce very high premiums as they get older, and this is usually with universal type policies, as they get older, they can sell off that policy, and that tends to be sort of an affluent clientele. The other are with people who have what we call smaller face or smaller death benefit policies, and they sell their policies predominantly as a source of cash to pay for various life issues such as assisted living, nursing home, and medical costs. So the way the market works basically is very similar to real estate in the sense that people go to a broker, and a broker who is licensed to settle a life insurance policy sells that insurance policy to an investor. So for instance, at Air Asset Management, we run several strategies, but namely our flagship strategy is an open-ended hedge fund that buys other people's insurance policies. And the benefit of this, essentially to us, is we create an alternative investment option for ourselves. And for other people, they get to monetize an asset. So the way it basically works is we will purchase the policy. The person remains the insured, but we become the owner of it. And to keep that policy in force, we pay premiums on it. So we cash settle the policy up front. Now, if you think about it, you can create or construct a portfolio of many of these, and you can achieve diversification. And if you think about it, a portfolio of life insurance policies really is similar to a portfolio of zero coupon bonds. The difference is that there's no real stated maturity, because the maturity in a life insurance policy is a calculated or an anticipated life expectancy. So those are kind of the basics. It's really a transfer of risk. And we currently own about 550 policies, and we run about $600 million in assets under management.
Thanks, Steve. So if you take a look at this slide, you'll see that 90% of life insurance policies that are terminated on an annual basis are either lapsed or surrendered each year, meaning that insureds do not know that this is an option. Many of them don't. So Steve, with that in mind, how big could the life settlement market be?
Well, I'll give you some perspective. Right now, we think it could grow to probably, 225 to 250. We have projections here of around 233 billion over the next few years. Life insurance policies in force in the United States are currently $20 trillion. Okay, so if you think about that, the growth potential alone, if roughly 230 billion is accurate, is a small percentage of that number. Currently in force, life settlements in force, which is different than life insurance in force. Life settlements in force, that is, life insurance policies that are held by investors, run approximately $150 billion of what we call face value or death benefit.
Awesome. So what type of return profile can investors expect from life settlement funds or funds of this nature? And why should investors consider adding this to their portfolios?
We'll touch a slide that kind of points to that in a second here. Came up. So when I first started in this asset class, I'd come from different backgrounds in capital markets and investment banking. One of the things that I found about this market, this asset class itself, I found so fascinating, was that the total return profile, by its very nature, was and continues to be very non-correlated to the returns of traditional asset classes. In addition, the returns tend to exhibit very, very low volatility. So when you look at the risk-adjusted return of the asset class, I have not seen anything that really approaches it in the hedge fund space, to that matter, or even in the private equity space. It's harder to gauge volatility there, of course, because of fair market valuation. But nonetheless, the thing that really stood out to me was this true non-correlation, diversification, and very high Sharpe ratios. And it was really, when I first started to learn about this market many years ago, it was probably one of the most palpable things that occurred to me.
Awesome. So can you touch on this slide a little bit?
So this gives you a bit of an example. What we do at Air Asset Management is we actually created a life settlement composite index, which is made up or consists of many life settlement funds, both closed-ended and open-ended funds. And in doing so, we looked at the returns of the asset class. We went back, and remember, this is a burgeoning space. So a lot of the good data that we had went back to February of 18. But what we did is we really wanted to plot the returns of this asset class, and we're here talking about the asset class as a whole, versus the returns of the S&P. And we wanted to look at it during drawdown periods. And if you look at the drawdown periods, the major drawdown periods going back to February 18 in the S&P, it becomes self-evident how well the asset class itself has performed vis-a-vis the S&P. And as indicated in this particular slide, it's intuitive that the level of volatility is much, much, much lower than it is in other asset classes.
Let's talk a little bit more about volatility and exactly what this slide means to you and how life settlements really can complement a portfolio.
I mean, anybody here who's, used to the capital asset pricing model or is a portfolio manager recognizes this. What's very helpful, this is called the efficient frontier. And what's very helpful about this particular slide is we can plot the returns of different asset classes on a graph that basically looks at that level of return in relation to risk. And a standard measure of risk is volatility. That is the standard deviations of returns over a particular time period. And as we can see, if you plot these different asset classes such as treasury bills, government bonds, small cap domestic stocks, and so on, as an asset class, they capture or they generate a certain return with respect or vis-a-vis a certain level of standard deviation. By plotting this graph out, we create a frontier which we call the efficient frontier. This is where we can expect to generate a certain level of return for each one of these asset classes given a level of risk. Any asset that generates a return to the left or above this particular efficient frontier is outperforming. And it becomes self-evident that life settlements as an asset class generate a given level of return for a given level of risk that's far superior to the returns of other asset classes. One of the things I was mentioning before is in buying smaller face policies, as we call them, with death benefits that range, let's say, anywhere from $100,000 up to $750,000. The people who are selling those policies tend to need to monetize that asset, and many of them don't even know that they can. By settling their policy, we are essentially providing them with an immediate cash value that often can be 7 to 8 times more than the cash surrender value that may be inherent with that particular policy. And in looking at this, we analyzed it. I'll let you talk about it a little bit, but it became very apparent to us that there really is an SRI component to this.
Yeah, so Air Asset Management is actually a signatory for the Principles of Responsible Investing. And as you know, and have learned today, our main strategy has been life settlements. So when we presented and applied for this PRI signatory position, we really had to investigate, okay, what is the impact to insureds for these life settlements? Mm-hmm. And as Steve said, they can on average get 7 to 8 times more than the cash surrender value of their policies. I think it's very normal for an investor to get hung up or caught up on the mortality aspect of this asset class. Mm-hmm. That's an obvious factor that we don't, as a society love to talk about. But really the important thing to remember is that we are putting cash in hand of these insureds. We are putting cash in their hands that they can use for assisted living, medical expenses, et cetera. And in the United States today, 80% of Americans currently fall short of conservative retirement savings. So we find this to be an incredibly additional value add to the insured population.
Yeah, and I mean, we also speak, we speak to people who sell their policies. And often people will say, they'll be incredibly thankful for getting a certain amount of money that may be 7, 8, 9, 10 times more than what they would have gotten from the insurance company if they went back and surrendered that policy. And, to see how positive or to see how content people are with this capability is, actually kind of rewarding. And I'll be frank, is, an unexpected added value to what we do. There are other situations where people, affluent folks who will settle a policy and take the cash and end up putting it into a foundation or into some kind of environmental cause. So, you start to sort of see that transition of value going through into areas that, one, help people, and then secondly, can also help some of the ESG or maybe environmental or social concerns that people have. And, as a business, that becomes, it's a very satisfying thing for us.
Yeah, it's one thing to make money, but it's another thing to make money and have a social impact that's proven, right?
Yeah.
And with that, we are complete. So we'll open it up to questions if anybody has any.
Would love to hear them, and I think we beat it by 46 seconds. Excellent.
Oh, right on time.
Yeah.
One back.
In the year 2021, what was your experience
COVID.
Of payoffs on the portfolio as opposed to other years?
So there's a long answer to that. I'll be very quick. I'll try to summarize it up. It's a great question, and it's one that investors ask us all the time. Very little impact whatsoever. There's some analytical work now that's coming out, but if you look at our market as being two-tiered, the smaller face policies that I talked about, as well as the more affluent, basically grandma and grandpa stayed away from their grandchildren during COVID, and the impact in the more affluent policies was very, very small. There is some anecdotal data that's coming out now that really talks to some of the smaller face policies having a little bit of an impact because a lot of folks were in areas where there was less vaccination and less health care. But, for our strategy, very little impact, negligible.
Any
Thanks
other
for that.
questions?
I'm saying, how do you invest in a life settlement?
Oh, okay. So we actually commingle these life settlements in a proprietary vehicle. We have open-end hedge fund structures as well as closed-end hedge fund structures. You want to touch on?
Yeah, I didn't hear the question. Was how do you invest in it?
Yeah.
Oh, it's a private, Reg D hedge fund that we run in several of them, and you could be either a qualified purchaser or a qualified client, and subscribe to the fund, which is basically made up of a diversified portfolio of policies.
And what's the minimum requirement for that?
$250,000.
Yeah.
250.
Amazing.
All
Thank
right.
you, everybody.
Thank you so much, everyone, for listening. Appreciate it. And Richard, thank you for having us.